This is Annuity Straight Talk. Since 2008, your host, Bryan Anderson, has helped clients nationwide navigate the complex market for annuities. With Bryan's assistance, hundreds of clients have achieved a profitable and secure retirement. I would know, because Bryan has answered many of my questions concerning annuities and retirement planning. So that you can benefit as well, let's get started. Here's Bryan.
Hello and welcome everyone to the Annuity Straight Talk podcast, episode number 18. My name is Bryan Anderson, founder and creator of Annuity Straight Talk, and today, once again for the second time, I have a special guest who is a man I've come to know fairly well over the last few months. His name is John Balmer. He's down in Los Angeles, California. Say hello, John.
Hi, everyone. Bryan, thanks for having me on again. I really appreciate it.
It's my pleasure, and I like the fact that we got warmed up and just BS'd for about 20 minutes. John and I, well, it was kind of my idea. I'm not sure he's sold on it, but I kind of think that we ought to start our own talk show because we've got some really good ideas on all sorts of different social issues going on right now. But today we're going to try to stick to annuities, investments, and safe money ideas. What do you think, John?
I think that's a great idea. Well, we could save that talk show for another time.
Yeah, and a lot of it has to do with my backdrop. It is hunting season coming in Montana. Everybody knows. A lot of people know I went out with a bow a few weeks ago. I did not score success on that one. I enjoyed some time out in the woods with a buddy of mine. But rifle season's coming up, so I got to get things tuned. And it's kind of one of those things you got to be comfortable with the tools you use, right, John?
That's right. Absolutely.
I don't necessarily sleep with the rifle, but I will handle it and carry it around and pull the magazine out and work it back and forth. Of course, gun safety is a big issue here. Not a problem. There are no bullets in that gun right now, but a couple weeks there will be. So. But it's not something you get away with in California, right?
No, absolutely not. It's it's probably a felony. So.
Oh, come on! It's just a rifle.
Yeah, I know.
It's legal everywhere. It's a man's toy. So anyway, I was thinking about John. One of the things I thought about, and again, I tell everybody this as many times as I need to, so it sinks in. A big part of what I've been doing this year is kind of branching out and getting different perspectives from people. John's a registered investment advisor in Los Angeles, works for a big firm down there. He's got a lot of alternative ideas. Of course, he believes in the annuity track and where appropriate for retirees and whatnot. But John, you don't necessarily work just with retirees like I do. You have a little bit different focus, right?
Yeah, we have a pretty broad focus in terms of our practice. We do a lot of installment sales, and that would probably be for another entire different episode called the Deferred Sales Trust. It's one of our things that's proprietary to our firm. It's deferring capital gains on highly appreciated assets and real estate. But we work with a broad set of clients, trying to provide alternative investment solutions to them just outside of your stocks, bonds, and cash. Annuities is a big part of our practice. But there's a lot of other things that we can talk about that might, be interesting to your audience today that I can explain a little bit further in detail, and we can go from there.
Yeah, and part of to honor the difference between an insurance guy like me and an investment guy like you, I kind of thought a lot of people now, and I'll tell you, I've got a lot of clients, and it's not just for those clients, but there's a lot of people I know who don't want to take risk with anything they've got. And so in the market, it's very difficult to diversify because there aren't a lot of options out there. And this is something that's also would maybe provide some ideas for people who want to protect some of what they got, but they maybe don't like the annuity options. So that's why we call it Annuity Alternatives. And, thinking, that you had a different perspective, we could go back to some of the things that I've pointed out people could do to reduce risk in a portfolio or manage risk, like you've said in the past. But an idea just to run through some of those, and maybe you've got a couple of new ideas of things people can contact us and get started on. What do you think about that?
Yeah, sure. Absolutely. There's a lot of different alternative investments that we use at our firm. And, more often than not, as as you know, the fixed income market, yields and savings rates are at such low levels these days. People are stretching for yield, and sometimes they're taking oversized risks, and that's how we can really couple the annuity in someone's retirement portfolio or in someone's portfolio in general with income producing assets like non-traded preferred shares, different non-traded alternative investments, as well as buffered exchange traded funds or buffered ETFs. Those are becoming more and more popular in the marketplace. Issued by very large providers like ProShares and Direction. There's a fund company out there called Innovator Funds that provides a whole suite of buffered exchange traded funds. So it gives you the ability to capture a lot of the upside, but also not capture all of the downside. And I think that's something that people might be interested in.
No, I was going to say it certainly would be, and I think kind of some of those things was explained in more detail. But until now, like there's been, and that's what I liked about some of the things you've told me is that it was really interesting to hear there's some other options for people that don't necessarily want the commitment of an annuity, right?
Yeah, absolutely. It provides a little bit more liquidity as well.
Yeah. So I have, let's see. And I was talking about how I was somewhat prophetic in this. Way before anything happened, the virus in China. This is 2020, right? Risk reduction. Okay. And we don't need to spend a whole lot of time on this stuff, but, people kind of have like a limited idea of what's available, money market or savings or a CD, something like that. Those are pretty miserable rates right now, don't you think?
Yeah, absolutely. I mean, 0.5%, less than 0.5% on your money
for a 5-year commitment on a CD.
Yeah, absolutely. It's pathetic.
Yeah. So, and then obviously there, it's fully taxable. So you got a taxable 0.5% on a 5-year commitment.
Yeah.
That sounds pretty weak, to be honest with you. And then, the traditional asset has been the bonds. So traditionally speaking, it's just kind of like stocks, bonds, bond coupons, stock dividends. You'll be fine. 4% rule, all that stuff. We're talking retirement, of course. But again, those still aren't paying very good rates either. And with rates potentially going higher and having spiked a little bit in the last few weeks, there's a bit of risk there as well.
Yeah, for sure. Risk disclaimer, this is for educational purposes only, but yeah, of course, if you're a long bond holder and interest rates continue to spike on you, you're going to suffer some principal loss. And it's interesting that I come across a lot of different people who have muni bond portfolios or portfolios of different types of fixed income securities where the prices of those bonds continues to go up, and that's because interest rates have been falling for 30 years. So what's the alternative now that interest rates are potentially, or in the last several months, have started to turn the corner and go back up? What's the potential risk, and what are some alternatives?
It's not necessarily a safe place where you're going to get your interest payment, unless it really goes to hell. You're going to get your interest payment, but the underlying value is going to drop. So you don't really have a whole lot of liquidity because you're selling a depressed asset.
Yeah,
right?
Absolutely.
Well, and that's why maybe traditionally they did get a good rap because of falling rates where the price was increasing over time. And so that was kind of the bond prices going up and the market going up at the same time. So you've got to have maybe more protection in place and a smarter strategy these days. So you've got protection on at least one side at a time.
Yeah, I agree.
Okay. So bonds there. And this is one thing you can talk about. I just mentioned it in the newsletter. Hedging strategies. People are selling options, protect the downside. Anything you got to say about that in particular?
Yeah, there's a lot of different strategies out there for the retail investor. Writing options or selling options to hedge your portfolio is a very complicated strategy. It takes a lot of time, a lot of education. It's definitely something you want to leave to a professional. It's not something that I particularly do for our clients. But we do have, as I mentioned before, there are a lot of different ETF issuers or exchange traded fund issuers out there in the marketplace now that are actually wrapping those types of professionally managed strategies within a single ticker investment vehicle called an exchange traded fund. And a lot of these are providing buffered strategies. So, whether it be on the S&P 500 or the Dow Jones or the NASDAQ 100, there's a lot of different options out there where you can actually, you can capture a lot of the upside, but you're also limiting your downside, and you really kind of pick your flavor. It's, you can protect down 5%, you can protect down 10%, you can protect down 30% in some certain vehicles, and these come out every month, so you can continually buy them. And within that period of time, if the market does subsequently suffer a significant downturn, you're buffered for X number of percentage on the downside, and before your actual losses kick in. So it's a pretty interesting vehicle these days.
And would you say that's something that's decent for a retiree who wants a little bit of market exposure for growth or inflation protection? Would that be something reasonable a retiree could do?
In terms of a successful portfolio and a successful portfolio management, I think that definitely looking at these vehicles in replacement of some of your broad market indices, it could be a potential alternative to those. So you are providing that downside protection, but of course, yeah, I mean, you have to definitely look at what your risk tolerance is. Is it suitable for you? Is it going to be the right thing for you? But it definitely could be an alternative to maybe a core holding of yours, or if you have a portfolio that's for a longer time horizon, you don't want to take those significant down. The S&P 500 of the market, the broad market, falls on average, intra-year about 14% peak to trough. And so when we take a look at that, well, do we think it's the next 2008 or the next February 2020? We don't know. We don't know when these events are happening. But on average, you do get a lot of these pullbacks. So, to put these vehicles in place in a portfolio, if it's designed properly, can help buffer some of that emotional roller coaster that investors go on when the markets start to get volatile.
Oh, that's really interesting. I think one of the reasons I put this in that newsletter way back when was because I meet a lot of people and we talk about index annuities, and you don't have to go too far into that, but they talk about, buying, the companies buying options, and you're leveraging low rates with index options to get a higher return. And some people say, oh, I'm just going to go buy my own options and I'll just do it that way and I'll make more money. And I think that's kind of like, to me, it's kind of like the average guy going in to do that, just to buy options, quote unquote, buy options. I'm just going to go do it. That's kind of like people walking out of a Jimmy Buffett concert with a Hawaiian shirt on and going to the poker table in Vegas with Johnny Chan saying, let's try poker.
Right. Absolutely. Options are definitely something that you need education on. It's not something that we do for our clients, just because there is so many facets and so many things, it's so much risk involved. You actually have to know exactly what you're doing. Otherwise, you are opening up yourself up to liability if you're an advisor, and then you're opening up yourself to potential losses if you're an investor doing it on your own. And I know that we've seen an explosion in the derivatives markets, in option activity, with apps like Robinhood and Webull and a lot of the other online trading platforms. And we saw what that can do to markets in terms of the certain meme stocks that we saw earlier this year, AMC and GameStop. A lot of those were really driven by option activity by retail investors. It can be a very dangerous place to swim if you don't know what you're doing. So always seek professional help, seek professional advice from someone who knows exactly what they're doing.
Very well put. And I think, like I said in here, it's not for the faint of heart. So better prepared to saddle up and go for a ride, right?
Yeah, absolutely.
Okay. Yeah. So, and the last one I had in here is just which a lot of people do. And my co-host Ashok does this a lot with people that are just seeking safety in retirement, is just plain old dividend stocks. I talk about blue chips, utilities, things like that, where, you don't get a highly volatile asset value. So your price doesn't typically move. It's not strictly correlated with the overall stock market, but you get a consistency in dividends over time. What do you think about that?
Yeah, I actually love dividend stocks. We have several strategies that we can implement, whether they be individual equities or within a fund structure. The aristocrat strategy is really a popular strategy among the investing public. It's dividend growers, companies that are consistently raising their dividends over periods of time. Companies with really strong balance sheet who want to return capital to their shareholders. It's definitely something that can help buffer. And you always hear this debate of growth versus value in terms of investing. You think of growth, you think of high tech, you think of high multiples, the Facebooks, the Amazons, the Apples, the DocuSigns of the world. But you're also, a lot of people, they want that upside return in terms of equities, but they also like the dividend factor. So, companies like IBM, companies like Caterpillar, companies like Verizon, AT&T, a lot of the energy companies, they return a lot of capital back to their shareholders in the form of dividend payments. And so they can be a really attractive, yet perhaps less volatile way to invest your money if you're looking to invest in the equity markets.
Okay. And that's certainly an option for someone who, obviously, because you can get in and out of those anytime you want to, right?
Yeah, absolutely. If it's liquid within a fund structure, it's just a sell. You're not typically locked up for a period of time. Obviously those will fluctuate with the overall market, though, and we've seen that. It all depends. What I typically recommend for clients is to have a diversified portfolio of equities within a fund structure, because you're not subject to single stock risk. I mean, that's a factor that you always want to make sure that you are aware of, is single stock risk. You don't want something bad coming out in the news and dropping the stock by 10, 15, 20%. And we can certainly see that happen.
Yeah, the definition of a diversified portfolio, right?
Absolutely.
Which is, the Ken Fisher's, like the 80 stocks in an individual portfolio. Well, that's about what it is. I've seen the statements. There's nothing too special about it.
Yeah, Fisher, he's obviously a marketing genius. They run money. They build individual indexing, individual single stock portfolios. It allows for a little bit better tax management if you're an investor looking for diversification and tax management in terms of your investments.
Long-term capital gains and stuff like that.
Yeah, absolutely. You can do what's called tax loss harvesting. It's an interesting way to manage money, and they're particularly good at it. The problem is that you can't really at that scale get so custom. I have a lot of clients who want customized portfolios. And, if I had 1,000 or 2,000 or 5,000 clients, it's really difficult to do on an individual basis. That you start having to really kind of have one size fits all.
That's one thing that I've talked about investment managers saying, with all the rules and regulations in place, it's really hard for a guy to offer custom management to any one client when he's got $200 or $300 million under management, because you either got to have discretionary control over the account, but you got to leave voicemails and you got to have instructions and sometimes written and all that stuff, right? So it can get pretty difficult to have immediate control over something or be able to make quick moves for every single person on a client list, I think. So
yeah, absolutely. On a scale, when you're talking about 200 to 300 clients or X number of assets under management, it becomes really difficult. I mean, obviously, you got to think about how many different types of investments that you have to keep track of. from a time perspective, it becomes a very daunting task unless you have a whole team that's behind you. If you do, that's great. You have people dedicated to certain sectors that are going to cover. But for the average retail investor, I think that the fund structure, particularly the ETF structure, coupled with an annuity or different types of annuities and some alternative investments, could potentially really help you reach your goals.
Yeah, it's really fairly simple. And again, the annuity's got to play a part in it for retirement, or it should anyhow. But this is again just a diversification opportunity for people who want to protect everything, but you probably shouldn't have all your money into annuities, right? And for people that are hesitant of annuities but still want some protection, what can we do? So what this is again, Annuity Alternatives on Annuity Straight Talk podcast. My name is Bryan Anderson. I got John Balmer in LA. If you want to talk to either one of us, you can get a hold of me. The number is 800-438-5121, or you can go to the website, annuitystraighttalk.com, the newsletter homepage. And I'm going to show you guys that real quick, but you can see, let me share it again. I want to point this out in case you guys don't know about it. On the newsletter. So this is a newsletter I pulled up from February 1st, 2020. You can go to the newsletter page right here, and you can hit the search box. So I'm going to pick a quick one, and I'll show you. Social Security. Let's say you want to read about that. And I'm going to do an episode about this next week, how to really maximize Social Security, March of 2019. So free Social Security optimization report, boost your Social Security check. All this stuff that I've written over the past 12 years is there and searchable if you want to check out a question you have. So that's how you do it. But if you want to get a hold of us, schedule a call, click the button here. Boom. It's easy. Initial consultation, pick your time zone, set a time zone, type your name in and your questions. It is a piece of cake. So that's how it works. Green, schedule a call. We're here if you need something. You want to get a hold of John, I'll have his name up here as well at some point in time. But for now, just want to let you guys know. And now that we've kind of covered my my newsletter, which is a very basic report, John, you had a couple other ideas that I kind of want to finish with that were, I thought, very interesting. And I've actually got a couple of clients of mine that I've directed your way that are very interested in a couple other options that provide some assurances. So if you've got something to show us or you want to talk about those a little bit, I would definitely consider it to be an annuity alternative, but I'll leave that to you. And again, this is not investment advice. This is not a recommendation to purchase anything. Speak with qualified financial advisors. We'd have to know more about your specific situation before we determined whether any of these were appropriate for you. So without further ado, if that's good enough for a legal disclaimer, John.
Sure, absolutely. Typically, what I've found is with clients is people are looking for liquidity. They're looking for a higher rate of return. They don't want the volatility. So there are a few companies out there that are issuing preferred shares, and most Fortune 500 companies issue preferred shares. And you can find them on your retail brokerage platform. You can find them through your local financial advisor, preferred shares. The problem with a lot of preferred shares is that they're actually traded. And so when we look at traded preferred shares, they're subject to the volatility in the market, supply and demand of the market. You're looking for stability of principal. We have different types of vehicles within the preferred shared realm that are actually stated value. And what that means is basically the share price is stated by the company. It's issued on top of the common equity. In terms of the capital structure of the company, there's typically common equity, preferred shares, and then there's the debt of the company. So, when we're taking a look at preferred shares, they're typically an option for investors for a portion of their portfolio that, when we take a look at them, they can offer attractive rates of return anywhere between 4 and I've seen them as high as 7%. So, if you take a look at, different types of companies, mostly in the real estate sector, publicly traded REITs sometimes will offer these types of investments. So when you take a look at, there's a couple different offerings that we have. Don't want to be very much company specific, but if you're looking for stability of principal, you're looking for a senior position to the common equity of the company. You're looking for principal growth with an annual stock dividend, and stability of that principal. You're going to look at different types of non-traded preferreds. So these are typically issued by the company for anywhere between 3 and 5 years. And I've seen them as low as 4.5%, and I've seen them as high as 7%. So income is paid on a monthly basis, and when the term is up, some of these are actually callable. So when the company calls these shares, they actually will either give you common equity or they give you your cash back at the stated value. So, for example,
you'd have the choice.
Yeah, so it just really depends. You want to know exactly what you're going into from the get-go, but there are some companies where it's cash in, cash out. So, let's say you put in $25,000 in, you're going to collect 6.5% along the way. And let's say after 2 years, they call those or redeem those shares, you're actually going to get your $25,000 back. And you want to know that ahead of time. Some companies will say, "Hey, look, we're gonna take that $25,000. We're gonna pay you 5.5% annualized, but it's going to be paid out on a monthly basis. So you're going to get a check in the mail or a dividend back or distribution back into your brokerage account." And then they're going to say, "Hey, we're going to redeem that, or we're going to let it go full cycle. And we're going to actually deposit common shares or common equity back into your brokerage account." So what does that mean? That means at that point, you're subject to the volatility of the market. And if the market's having a bad day, that stock might be down. So you've got to actually know the timing of that issuance so you can sell that stock, go back into the common shares if they're offered, or look for another spot to place your money.
Right, but once it's back in the common shares, you have full liquidity, right?
Absolutely.
So you could sell at any time.
Yeah, and there are liquidity features in some of these preferred shares where, very much like a CD, they might penalize you a year's worth of interest. So if it's 5.5%, they may say, "Hey, it's a 5.5% redemption fee." So theoretically, if you're in it for over a year, you're pretty much going to break even, but there are liquidity features because they're publicly traded companies. It's not necessarily traded on an exchange, but it is a share within their capital structure that they have to honor and redeem if you so see fit.
So it's a senior position debt instrument, essentially.
It is, yeah. It's an equity position, but it's
okay.
If you're familiar with how preferred shares work, they typically aren't as fluctuating as the common shares. They're not subject to as much volatility as common shares. They typically will provide more of an income stream to the investor rather than common shares, above and beyond maybe a dividend that the common shares might pay.
Right. So it sounds like what a lot of people would be pretty happy with it. And again, in small part, you're not going to put everything into it, but just a nice alternative for annuities. Real quick, just because people are going to ask, that is the income paid from those preferred shares is going to be taxable as ordinary income, correct?
Yeah, well, it depends on what type of an account structure. I mean, these are available in retirement accounts, IRAs, Roth IRAs, and then that income is not subject to taxation. But if you have it in an after-tax brokerage account, because some of the companies that issue these shares are different types of real estate companies, some of that income is actually sheltered from taxation. It's company specific. I can't exactly riddle off which ones, but
Yeah, it depends on where it came from on their part too, right?
it does. It depends on the issuer. So, whether it be coming from a large publicly traded real estate investment trust, or if it's coming from a large publicly traded business development company, or a different type of company in a different industry. It all depends on how they treat that income.
Right. Okay. Sounds very interesting to me. So like I said, I've got a couple people interested in that. And I thought it was a really nice addition to kind of like enhance the newsletter I wrote, because a lot of people are maybe interested or not, or a little concerned about the commitment of a long-term annuity. If they even say, 5 or 8 or 10 years, whatever it would be, looking for alternatives outside of that. So, I think that's a pretty good one. Don't you?
Yeah, I have a lot of clients who have these in their portfolio. They've been happy with them. Nothing comes without risk, unless you're in a guaranteed annuity. But these offer a fairly good alternative in terms of income. Certainly more stability of principal than, let's say, a long bond or a municipal bond, in this type of an interest rate environment. You're not taking a huge stretch for that income. You're not going way out on the credit spectrum.
Right. We're not, I mean, to get rates like that in the bond market, you're going to have to go to like Guatemala, right? Or
Right.
Mexico.
Yeah. Bank of Kazakhstan, or different credit issues around the world. Stuff that I dealt with at BlackRock. We've seen it all. So it just depends on how far out on the curve you want to go.
Yeah. And I had a client, I get clients that ask me, hey, what do you think about this or this or this? And they had, some sort of, global bond fund that was paying 4.5% dividend, but there wasn't a single issuance that was better than B rated. Many of them were B minus. So they had 80% of their bond holdings below investment grade, which is why the rating was 4.5%. Now, this is an extremely risk averse guy who was looking for a 4 to 5% yield. And I said, listen, that's not really giving you what you're looking for, because there's some credit risk in that.
Oh, absolutely. Well, if you take a look at it, long only bond fund managers, they have to buy what's in their index. They're mandated to. And so obviously, a lot of them are going to talk their book. They're never going to talk to you about how, a lot of different bond fixed income strategies, which are, usually considered safe, we're down anywhere between 10 and 20% last March. That's a scary proposition if you're 65 or 70 years old, to have your fixed income portion of your portfolio drop in such a significant manner. Now, yes, they did pop back up, but what if they hadn't? Obviously we saw the Fed buying an unprecedented amount of fixed income, even in the marketplace. They started buying ETFs.
Mm-hmm. No, and I think a lot of people will see it, maybe not understand it. And the idea of pointing it out, as I've done for several years, is just to let people know that it's not necessarily as stable as they think it is. And so true stability can only be found in a few places.
Yeah, that's right. That's right. Absolutely.
And only one of them really has any yield to it. So that's why I'm an annuity guy. But, and everybody will realize this now. Obviously, John knows what he's talking about. An exceptionally good investment manager. And that's kind of one of the facets I wanted to add to my business this year. So John, thank you for sharing your expertise with us today. And if anybody wants to get a hold of us, I'd be happy to introduce you to John. Again, once I get my website ready. Now, I had a little hiccup with the website redesign. Some guy flagged out on us at the very last minute.
Yeah, what happened with that?
I don't know. He just didn't want to get, it was interesting. We said, hey, that looks really good, except we like this, and this differently. And he got real huffy about it and said, all right, I quit. So, yeah, I mean, the money was on escrow with the company we hired to find him, and
sure,
he's not going to get paid for it. I thought, well, come on, let me give you like $500, just like wipe away your tears and do the job, man. I mean, what do you think? I don't take heat here. I'm talking about annuities all the time. People say the worst things to me. I don't care.
Yeah.
Whatever. I play for the ones I win, John. I play for the ones I win.
I know you do. So.
All right. Well, cool. I think we wrapped it up. You got anything else to add to that, John?
No, No, that's it. And if you have any questions about annuities or preferred shares, something that might be able to add some income to your portfolio in such a low yielding environment, feel free to give Bryan or I a call. And we look forward to educating you on the best options for you.
Why don't you plug your phone number there, John, so they can call you?
Sure.
And let them know you saw the podcast when you call them.
Yeah, absolutely. You can reach me at 949-478-2256. That's my direct dial number to my office here. I'd be happy to talk to you.
Okay, great. And like I said, we'll have him on the website once he clears it with his compliance guy and says, "Oh yeah, that guy in Montana."
That's
all right, fine. You could be on there. We'll get you guys all hooked up. We're a full service shop. So again, we hope you guys enjoyed it. The podcast, again, on all popular podcast platforms, hosted by Castos, found anywhere else. Go ahead and subscribe if you want to be notified as soon as the next episode is released. Also, the video is on YouTube. You can see the screen shares, or you can look at our beautiful smiling faces on the video on YouTube. Go to youtube.com. Just search Annuity Straight Talk. You can subscribe to it there as well. Again, you'll get notified when a new episode comes out. So AnnuityStraightTalk.com, 800-438-5121. John, thank you.
Bryan, thank you. I appreciate it for the second time. Definitely look forward to doing it again.
Come up with another idea like this and we'll do it again, okay?
Sounds good.
Okay, thank you, everyone. Have a great day, and we'll see you next time. Bye.
You have been listening to Annuity Straight Talk. The preceding information is for informational and educational purposes only and does not represent tax, legal, or investment advice. The views expressed by guests on this program are their own and do not necessarily reflect the views of Annuity Straight Talk or its partners. No information presented today should be acted upon without meeting with a qualified and licensed professional. It is important that you read all insurance contract disclosures carefully before making a purchase decision. Guarantees are based on the financial strength and claims paying ability of the insurance company.